If all of your debt is denominated in fiat, and all of a sudden there's a huge debasement issue where significantly there's more fiat dollars available, all of a sudden your calculus on your future liabilities is wrong. And if you can add this new risk that moves opposite of monetary debasement, you can improve the return and reduce the risk of your entire portfolio of assets. I think that perspective of being a reinsurance broker has given me a unique lens into the equity market, the financial world, thinking about collateral, and primarily this trade with Microstrategy. We're only getting started here, and it's a fascinating business proposition and how they're managing capital markets and transforming Bitcoin into different products that fit different risk return appetites for different investors. It's continuing to go up. You can think of this as like a 4-year plus bond and like start to wrap your head around like different usages of this asset class. If you don't do it, your competitor's doing it. China's doing it, Russia's doing it, UAE's doing it. All of a sudden, like that just exacerbates this accelerated game theory concept of losing power. That's the way this stuff is going to hit these insurance companies. I mean, they are desperate for this product, but they don't know they need it.
Hello, everybody, and welcome to My Two Sats. My name is CJK, and today I'm here with the one and only Jeff Walton, aka Punter Jeff. Now, he can punt a football 74 yards plus, but he will never punt a stock. This is a very strategic, beautiful, genius financial innovation. It's history in the making, what we're seeing going on in the markets. Jeff, thank you so much for taking the time to join me today.
Absolutely. Happy to be here.
So, tradition on my show for the audience, a little bit of a quick interview with your background, little history, and then the most important thing, your orange pill moment.
Yeah, absolutely. I'm happy to give a quick background. So, yeah, my name is Jeff Walton. Nice to meet everybody. And, I've got a long business and finance background. I studied business and economics in college, a double major, small liberal arts school here in Washington State. Graduated at the top of my class, played 2 sports, played baseball and football, and, had a ton of fun doing that. And from there, went right into working in finance. I originally wanted to, work at one of the big, banking firms in New York, but I got a job in reinsurance in Seattle, and I didn't have to go far. And I was able to get into this niche world of finance, which was reinsurance. I had no idea what I was doing. I had no idea about the capital world and where I could potentially go with this. Ended up falling in love with reinsurance because reinsurance as a niche financial market, you have a significant amount of freedom to design and structure financial tranches of risk that you can sell to different counterparties across the globe with very little regulation. So if you can think about it, you can design it, and you can sell it. Like there's generally a market for those types of products. Reinsurance itself is insurance for insurance companies, where you are reducing the volatility of an insurance company's balance sheet by designing these tranches of risks and offloading them to other companies across the globe. And yeah, that gives me a unique lens into the entire financial world, because the insurance market itself is very it's all interconnected with everything that's going on in financial markets, right? Insurance companies hold equities and bonds. Interest rates impact all insurance companies and how they manage their capital. You've got inflation, which is a really big impact on future claims, both from a property standpoint and a liability standpoint. So really, you've got to have a fundamental understanding of the entire financial world and how it kind of interacts to help these insurance companies manage their capital into the future. So I think that perspective of being a reinsurance broker has given me a unique lens into the equity market, the financial world, thinking about collateral, and primarily this trade with Microstrategy. I saw this kind of on the wall. And like a couple of years ago, I saw this potential and developed a thesis and a framework and an understanding of where the stock could go. And I just started talking to people on the internet, and here we are. So my name on Twitter is Punter Jeff, and that's where you can follow me. We do have a group of people called MSTR True North, which is our group. Basically, it's an investment club that a group of guys that gets together, and we talk about MicroStrategy, what's going on with Bitcoin, all up to date events. We go really deep on everything, and it's basically an investment club that we would have done internally. We're just broadcasting it to the entire world. So feel free to check it out. We do broadcast that on Mondays and Wednesdays, and it's a lot of fun. And then my orange pill moment. I think my orange pill moment is pretty unique. I actually heard about Bitcoin when I was in college in 2014. I had an senior econ thesis class, and there were 6 people in the class. 3 of the 6 did their thesis on Bitcoin. At the time, I was like, this sounds crazy. I have no idea what this stuff is. Like, I don't get it. And I just totally dismissed it. It came up again in 2016, 2017. I traded it. I had no idea what I was doing. It was just like everybody was buying it. So I bought some and I sold it. And then 2020 saw everything happening at the same time. Like everybody's at home doing a bunch of research. Like nobody had anything else to do. So you're like researching stocks and, everything. I started trading options in 2020 because I was, wanting to see how these products worked, and I wanted to, take some positions that were like leveraged. I started betting options on Sony around the PS5 launch, and understanding that Wall Street was underestimating how cool the PS5 was. Ultimately, you could have bought anything in 2020 and it would have gone up after COVID. But from there, I got interested in the GameStop trade, and I watched and participated on the ride of the entire GameStop trade. I liquidated my entire portfolio. I thought I was insane. Purchased GameStop shares, rode it to the top, and I was like game theorying my way through the entire process, which was incredibly challenging. Running through the game theory of like, who are the players in the game, right? Like it's more than just retail. There are hedge funds here. There are large banks. There are many people in this trade that don't need to make the return that the retail people want to make. And so I ultimately exited the trade kind of after Robinhood turned off the buy button, and it was very clear that there was manipulation going on. And I exited the trade, did really well. I know the GameStop people will hate me for exiting the trade, but like the game was over from a game theory perspective. So exited the trade, realized really quickly, like, okay, now I need somewhere else to put this. And that's kind of at the moment where I started diving headfirst into Bitcoin and other potential opportunities. So around that time, I don't know, I traded some other things in 2022, and saw that interest rates were starting to change. Ended up getting a house, getting an illiquid asset, and then I still had capital to play with. So I was looking at what was happening in the industry, like with like FTX was starting to get a little sketchy. Celsius, like all of these bad things were happening. I had purchased MicroStrategy at the time. I think it was like 2022, and like I think I bought it at 600 and like watched it go down, down, down. And then I realized like, okay, I'm still bullish on Bitcoin. I'm still bullish on MicroStrategy. I'm going to develop a strategy to maximize my return and maximize my position for the long run, thinking that Bitcoin's going to be back at some point in the future, 2025, 2024, 2025.
Now, what gave you that confidence that it was going to be back? What gave you that inner confidence? Was it a feeling or was it an understanding?
It was a little bit of both. So I started doing a lot of research. I read Unenumerated by Nick Szabo.
Okay.
And it was like this concept of currency. Like, what is currency? It's like the history of, the interstellar reason that gold is on the planet. And so it was a little bit of it was research, reading material, and running math, like looking at the numbers. So I had looked at and getting an understanding of how Bitcoin worked, how the code of Bitcoin worked, how the math behind the scenes worked. Understanding quickly started to understand like this is the most powerful computer network on the planet, and this is really just like a ledger of math. Like this is just keeping track of everything on a really big computer ledger. And I understood very quickly that this is going to go much, much higher. and is could be a multi-trillion-dollar asset class and can catch up with gold very quickly because the attributes of Bitcoin are significantly better than that of gold. So, in running the math and understanding like where we were going in an interest rate environment, where we were at with sentiment, where we were at with a future halving coming up in 2024, I wanted to see the performance of Bitcoin over time after post halving events and start to take a speculative position on what would happen after a halving event at some point in the future. So, and then how do I maximize that knowledge? And I was fascinated with how the stock of MicroStrategy performed relative to Bitcoin, and I wanted to know everything about it. I wanted to know like why did it happen? Who was buying MicroStrategy? Who announced? Like how did the announcements work? How is their company structured from a financial perspective? How does the debt work? What is their financial leverage? Who owns the company? Are they included in index funds? Who's Michael Saylor? And like like needed to go down that rabbit hole, which was a whole nother learning experience. And I ultimately established a strategy, a long-term, um, incredibly leveraged options position. And I was dollar cost averaging options in all of 2023, along with purchasing Bitcoin. I made a huge lump sum pile into Bitcoin in 2023 and started buying long-term call option leaps for all of 2023 on MicroStrategy with a thesis that it could be a $1 trillion company within a very short time horizon. So that was ultimately, oh, there we go. Yeah. So MicroStrategy today, market cap, it says 88 billion. I think it's actually in the 90s because that share count is significantly smaller. So when I started buying Leap options back in 2023, the market cap was around 2 to 3 billion. So a
Nice.
significant,
Beautiful.
yeah,
Beautiful.
it's been a great trade. It's been a phenomenal trade. I'm still holding on to the options. I'm upwards of like 130x on some of the options. They're in a really great position, and I think that we're only getting started here. And this is it's a fascinating business proposition in how they're managing capital markets and transforming Bitcoin into different products that fit different risk return appetites for different investors. So it's a fascinating value proposition. Thinking about the future of MicroStrategy 10, 20 years from now is also incredibly fascinating because Bitcoin is collateral. They don't have to sell the Bitcoin in order to create value from it. And eventually, I think there's going to be a situation where MicroStrategy may want to put that Bitcoin at risk to generate a yield. So
Mm.
that's probably
Yeah,
a
guys,
long
he
term
Jeff is smart enough to know at risk to generate yield, right? The two go
at
hand in
risk.
hand. Yield means counterparty risk all day, every day. But
Yep.
before we get into Bitcoin as collateral, because that is one of my favorite
It's a whole thing.
topics,
Yeah.
and I can't wait to hear what you have to say about it. I do want to talk a little bit more about MicroStrategy's financial engineering they got going on here. You mentioned
Yeah.
that they are taking Bitcoin and evolving it or upgrading it, whatever you want to say, using it as a tool that it is, as money to plug it into and fill different problems, right? Creating a solution to different problems in the world. One of those problems happens to be a $300 trillion fixed income market with no
Correct.
real rates of return. So let's dive in a little bit for my listeners, maybe who don't fully understand, and maybe for some more beginner level people, what is this financial engineering? What is Michael Saylor doing here? Can we, teach me like I'm a in ninth grade, I'm a freshman. I have a basic understanding of math. I don't really
Yep.
understand financial markets. What is Michael Saylor doing to leverage his understanding of Bitcoin, and how rare and important is it that the everyday person can actually participate in this operation?
Yeah. Well, I will try my best because it is a relatively complicated concept. Um, but yeah, so the debt market is a $300 trillion market, right? So there's $300 trillion of debt in the world, and so who owns the debt? You've got to think about who owns these products um, that these corporations are offering, and ultimately there are banks and pension funds and insurance companies all across the globe that have liabilities on their balance sheet, right? So think about a pension fund, for example. A pension fund holds all of these assets and are planning to sell the assets or utilize the assets to pay off their liabilities of the people that are going to be drawing off the pension fund at a point in time in the future. So, what those banks and pension funds do will match the duration of the liability with an upfront debt instrument. So if they think I'm going to have, let's just say $100 million of liabilities in the future, but I only have $80 million of assets right now, I need to find a product or a basket of products that can match my liability at some point in the future. So let's just say I need 8% return at some point in the future in order to match that future liability. So I think that's a fundamental understanding of, like, you got to think about who owns these debt instruments to begin even thinking about what is debt. So understanding the market design and the market players here, you start to think about what other asset classes can any of these institutions, banks, pension funds, insurance companies, whoever it may be, what kind of assets can they buy? What kind of assets can they buy? And what are the market pressures that are working against them? And there are some market pressures, i.e. inflation and monetary debasement, that are working against this calculus that all of these asset allocators are trying to meet their liabilities in the future. So these, and I'll use the example of an insurance company. An insurance company or even a pension fund or anything, they're using probabilistic statistical analysis to take into consideration, all of these potential things can happen in the world, and here's what my return will be at X period. Now, there's volatility in any of those circumstances, in any of those situations. So it's helpful to have a diversified portfolio of assets for these specific types of asset allocators that have future liabilities. It's helpful to have a diversified portfolio of assets to meet those future liabilities. Now the problem is, what's the problem if you have all of these assets and they're all correlated with each other, right? If they are all denominated in fiat, or if they are all tied to the equity market or the performance of the equity market, and are all subject to the same inflationary pressures, right? If all of your debt is denominated in fiat, and all of a sudden there's a huge debasement issue where significantly there's more fiat dollars available, all of a sudden your calculus on your future liabilities is wrong. And if you are a prudent asset allocator and you wanted to reduce the risk on your portfolio and reduce the risk on your balance sheet and reduce the risk of missing your future liability, you want to make sure that you're capturing all asset classes, such that if there's something wrong with one part of your portfolio, maybe the other part of your portfolio does well. And so this is the mathematical concept of diversification. This is called Markowitz modern portfolio theory. This was a Nobel Prize winning economic theory, which is the mathematical equation of diversification. And the concept is, if you add a new asset class to a basket of diversified risks that has different risk return metrics, it improves the return and reduces the risk of an entire portfolio. So that's where I think this is a really fascinating situation with what's happening with Bitcoin right now, is that you have all of these other assets that all of these asset allocators are holding on their balance sheet, and they all have the same risks of monetary debasement. And if you can add this new risk that moves opposite of monetary debasement, you can improve the risk, or improve the return, and reduce the risk of your entire portfolio of assets. So
that's so important in what you do too in insurance. And I know my listeners are probably laughing because I say it all the time. Concentration builds wealth and diversification preserves it. So, people ask me all the time, should I be diversified? And I say, are you living the life that you want to live, and can you live that life for the next until you die? And if the answer is no, then you should concentrate. And once you hit your home run, once you find your MicroStrategy, once you find your Bitcoin and it performs for you, then you diversify to preserve your wealth and maintain your quality of life and standard of living. So that's how that translates on the personal level. It's the businesses are thinking these same things. But I wonder, I have a specific question just to kind of interrupt your flow. I didn't mean to do that, but because
jump right in.
you're right in insurance, and I got to ask, like, is Bitcoin even being discussed? Are Bitcoin bonds being discussed, or debt that's correlated with Bitcoin and diversified? Is it even being thought about?
No. And it's I get laughed at. I go into conversations. I'll be in London, I'll be in Bermuda, I'll be in New York. I bring up the concept of Bitcoin. I bring up what MicroStrategy is doing. I talk about how their market cap is like, 15x, and I literally get laughed at by most people. Or they'll tell me, whatever they read on the news, Bitcoin facilitates terrorism. I'm like, dollars facilitate more terrorism than Bitcoin, right? Like, you want to talk about a dark money that you can't track, like a dollar.
Curious.
So it's we're still incredibly early. I think there are a select group of people that are generally interested in digital assets, but that's just personally, and it's almost like faux pas to talk about it, really. Like,
wow.
Here's the problem. Insurance regulators do not account for Bitcoin. So basically, even if an insurance company wanted to put Bitcoin on their balance sheet, you would get zero credit for it. So like the regulatory body, and I say the word regulator loosely, they're rating agencies, but they're kind of like a regulator. Basically, the rating agencies will give you zero credit for putting Bitcoin on your balance sheet, which basically means that you can't leverage against it. So like if you held it, you got to basically pretend it doesn't exist on your balance sheet, which like no insurance company is going to want to do that, right? Like they hold assets and they want to get that rating agency or regulatory framework where they get approval to like continue to lever against it. Like that leverage allows them to write more risk, to take on more risk. So we're incredibly early
because Bitcoin is like built for that. There's no asset with a better CAGR in the world. So what could reduce forward-looking risk better than Bitcoin, especially over those longer? It's like, it just baffles your mind, and especially in a marketplace where you said, it's loosely regulated, and they're not really regulators, but rating agencies. So you'd think like innovation would spark and start there.
Yeah,
it would start with the insurance companies.
So insurance companies are incredibly regulated. So like very highly regulated. Reinsurance companies, on the other hand, are not. It's a trust market. It's a very heavy trust market, and now let's flip over to the reinsurance side. So reinsurance is big capital, right? These are the ones that are taking on the risk of like global catastrophic disasters, right? This is really big capital, and there are some reinsurance companies that are beginning to add that to their balance sheet, but they still have some of the rating agency framework. There are other reinsurance companies that are holding these assets on their balance sheet, and they're non-rated entities, and they need to, in order to transact business with the insurance companies, they need to make the insurance companies feel comfortable with them being a non-rated entity, which is a big risk, right? That's a big risk. If you have a catastrophic disaster in your portfolio and 25% of your risk is with a non-rated entity and the collateral and the capital doesn't exist, you're bankrupt. And so there's this, push and pull where nobody's really been a first mover in the insurance market and have been like full on Bitcoin or full on digital assets yet. I think there are some insurance companies that have purchased it. Like I think Stone Ridge holds Bitcoin. Mass Mutual holds Bitcoin. I think they're like a life insurer. And so those are some companies that are holding it, but they have different capital structures. But
that's amazing, because I I don't know if you've heard of our People's Reserve Bitcoin bond yet, but now that
No.
going through that segment, I'm dying to kind of get your take on it, because I'm assuming that the biggest concern, especially with the ratings agencies, is the implied volatility of Bitcoin. Because
Yes.
what if that
Yes.
catastrophe takes place during a bear market, during a 70,
Yes.
80% drawdown, and the
Yes.
capital, like you said, the capital is not there. Now I'm bankrupt.
Yeah.
So, as a long-term Bitcoiner, we saw this problem on the personal level with cash flow, but then we also saw it in different marketplaces. Insurance is being one of those big marketplaces. Of course, we had the bank term funding program when they started raising interest rates, but there was no insurance term funding program for any of those claims coming in against that collateral held, which was devalued mark to market with that interest rate hiking campaign. So
Hmm.
that sparked some conversations in the circles that I'm in. And one of the ideas that we came up with, we call it a Bitcoin bond, and
Yep.
it's probably a misnomer, because it's really just a principal protected note. Uh,
Yep.
but nobody cares when you say that, right? But when you say Bitcoin
Yeah.
bond, people are like, "Oh, cool, tell me more." So what we wanted to do is we wanted to eliminate downside risk, right?
Yeah.
And that's where the
Yeah.
principal protection comes in. So
Hmm.
the first issuance that we're going to make is actually going to be an issuance that is from a private company that is issuing a US Treasury, 5-year US Treasury note combined with Bitcoin. So the way the
Is
note
it?
is
Yeah.
structured, it's 80% US Treasury,
Yep.
5-year, and then it's 20% Bitcoin. And
Yep.
now what happens is, and in the marketplace, you can come borrow against the cash equivalent at par value because it's
Yep.
cash equivalent.
Yep.
So if you need to tap into that liquidity at any time, you can do it, even if it's before maturation, we'll let you tap in at par. And what's left over is the Bitcoin, because after the 5 years, that 80% turns back into the 100% allocation. And
Yep.
what's left? So if Bitcoin goes down 50% in 5 years, which it might happen in 5 days, but it's not going to happen in 5 years.
5 years. Yeah. Yeah. Yeah.
Yeah. So but even if it did, you're talking about a 2% APY on
Yep.
that. And that's matching a lot of what they got in the notes and the bonds when they were forced
Yeah.
out the yield curve before. Now, if Bitcoin price stays the same, which obviously it's not going to, we're making new all-time highs today, guys. That's right. I saw
Yeah.
94 hit the ticker today.
94.
We're on our way to 100. So it's gonna rip. I believe this is the monetization of Bitcoin, but I
Yep.
believe this ties directly into our conversation, because this is also about financial engineering and financial innovation and the next evolution of Bitcoin after its monetization. Because now
Yeah.
people are going to start to open up to these things. I've heard you say before, I think, when it gets to 100,000, more people are going to start paying attention. When
Yeah.
it gets to the price of greater than a single family home, the
Hmm.
big capital players are going to start paying attention. And I
Right.
think we're going to get there a lot faster than people anticipate. So if,
Yep.
if if we got that kind of performance, if we just kept a 60% CAGR over 5 years, it's 10x. And now you're talking about a 40% APY. So you have a
Yep.
principal protected note paying
Yeah.
40% APY. Do you think that would fit good into
100.
reinsurance? And
100%. Yeah, 100%. And that's the way this stuff is going to hit these insurance companies. I mean, they are desperate for this product, but they don't know they need it.
yeah,
So it's insane. So when I go and talk to most of these insurance companies, um, at almost every single meeting I go into, the word inflation comes up in every
mm,
single meeting, and they're conflating the word inflation. um, they're they're throwing debasement into inflation. Like, they're just calling everything inflation, and
yeah,
they're not separating out like price inflation and debasement.
mm,
Okay, I think that's a huge. That's my hot 30,000 view of like the entire market looking down. Like, everybody thinks inflation is one thing, and they just accept it like it's taxes,
right,
and
right.
um, that's really concerning to me.
So
It's
give us your quick definition of, because I'm this way too, so I'm really excited to hear this.
Yeah.
Definition of inflation and then definition of debasement.
Yeah.
How do you
So
separate the two?
yeah, I mean, there is price inflation or consumer price index inflation, which takes into consideration uh, food and like things that you buy. we can have arguments about how that's constructed as well, because I think like breakfast foods in the CPI used to include bacon and eggs. Now it's only cereal.
Yeah.
So if you're comparing CPI over time, like those are two different things. Concerts used to be live in person concerts, and now digital concerts are included in CPI. So like that metric in itself is like a skewy, messed up metric.
Quick little
Now,
thing here, because I
yeah,
do want to just show people exactly what you're saying, because the official government headline is the current CPI equation. The
yeah,
Govflation headlines is the CPI going back to 1982 pre-substitution. So what Jeff is saying here is that they're picking and
ah,
choosing. They're picking
oh,
and
wow,
choosing, and
yeah,
it alters the numbers. And I think what we're really picking out here, when they're talking about debasement and inflation, they're talking about real returns. And you can see
hmm,
when you listen to the government, we have a positive real return. When you go back to the older government equation, which was more accurate, we have a negative return, which creates two different marketplace incentives. And that's why I think these things
correct,
are being talking about.
yeah, and the concept of monetary debasement that the entire market is not taking into consideration is if you go back and you look at the M2 money supply over time, the M2 money supply, you could take any time horizon. You could take 10 years, 20 years, 30 years. The compound annual growth rate of the M2 money supply is like 6.5%. And if you compare that to the compound annual growth rate of CPI over the same time horizon, you've got a delta of about 300 basis points. And so that delta between the money supply difference and the change in inflation, the change in the cost of goods, is the debasement factor that I think the most of the insurance industry is largely just including in inflation and not necessarily separating it out and thinking about them separately. And the reason I think this is a huge issue, yeah, the reason there you
There's
go, perfect.
M2.
This is
And
M2
by the
money.
way, I love that definition of debasement, the difference between money supply growth and then price inflation. That's a really cool way to organize it in your mind to kind of better understand and separate those two mechanisms.
Yeah, and it's fascinating to me because in the insurance market, the they've created a new term for inflation that it's interesting. They're calling it social inflation.
Hmm.
They've created this new term. You could Google it. You could Google social inflation, and basically, the concept of social inflation is that um, there are these larger jury verdicts that are larger than inflation. Basically, when these issues go to court, instead of what is anticipated to be a $5 million claim, it's a $10 million claim, and they're calling that delta the delta between inflation, or like what the inflation outcome should be to what the actual outcome is. They're calling that social inflation. That
Wow.
that
Interesting.
people, the jury verdicts are inflating uh, what the outcome of these losses should be based on social pressures. That's what they're
Hmm.
calling it. And it's like,
Interesting.
no, it's not social pressures. It's debasement. It's like their monetary conception of dollars is different because they're
Right.
getting debased over time. And it's fascinating to me. And like many people just accept these articles that are published as like fact, and without kind of considering, well, what are the factors at play here? Like this, there's more to this story. What is CPI? What are all these things? And so I have one general concern about the insurance industry, and it's the if okay, this could get a little complicated, but if you think about the government's debt position, right? We're $36 trillion in debt. Um, the government has been adding trillions of dollars of debt, I think like almost quarterly now at this point. To put that in perspective, $36 trillion is uh, 12 apples. It's 12 apples. It's 12 NVIDIAs. Where do we come up with 12 apples? Right? Like we got to be the country of America has got to be incredibly profitable for a long time. Oh, there it is. The debt clock, $36 trillion. How do we increase our profitability of America by 12 apples? It's pretty mind numbing to think about that position. So, and then on top of that, like we're in this elevated risk, or not this elevated interest rate environment, so that debt just keeps compounding faster and faster because they've issued all of these treasuries at higher interest rates, which leads to this kind of exponential growth in the potential debt calculus. So, how do you get out of a national debt that's so high, or get into a position where other countries are willing to lend you their money in exchange for these dollars at some point in the future? You have to print money. Like, that is the solution. You print money. So back to my concern with the insurance industry is, if your expectation of inflation or debasement runs away, right? Let's just say right now it's 6.5% inflation plus debasement. If that expectation goes from 6.5 to 7 to 8 to 9 to 10, and the uncertainty, your expectation of what that may be at some point in the future, if that becomes much more volatile, the entire long tail insurance industry is eviscerated. Like, nobody's willing to, like, think about it, right? If you've got a loss that you have to pay 5 years from now, but you have no idea what the loss may be, how do you price for it today? And this inflation expectation, this debasement expectation, is really important in how insurance companies and even pension funds and anybody that's like running a financial company takes into consideration. You better have a debasement hedge, right? Like, if your expectations of inflation run away, you better have a debasement hedge on your portfolio, or else your company's business model doesn't work anymore.
Right.
And
And
that's
it's not even necessarily their expectations. I talk about this a lot. Me and Lawrence Lepard seem to hit the nail on the head on this, but very few people talk about it, which is, you talked about the yield curve. And a lot of these insurance companies, correct me if I'm wrong, but when we were in ZIRP, they were forced out the yield curve because that's the only place you can get any yield at all. But now
right.
you're forced to hold for 10, 20 years. And like you just said, well, how do you price a claim 15 years when you don't know the rate and pace of change of the inflation plus debasement? And
Right.
it creates gaps on the balance sheet. And what's really interesting, I watch this like a hawk, but I'm not sure if you've seen this recently, because most people watch the 10-year 2-year, but
Yep.
I found that the 10-year 3-year is actually a lot more accurate, with a lot less
Okay.
time passing between normalization and typically aggressive rate change or slowdown in the economy. So we are literally 0.18% away from the 3-month T-bill and 10-year note normalizing. And what happens is, I'll pull up this chart for everybody that can see a little bit closer. What happens is, when you normalize, you get a 2 to 4% spread between the 10-year and the 3-month. And that means one of two things. The long end of the yield curve is either going to, and that it's gonna break up at around 5. And if you get 2 to 4 from 5, that means the 10-year could go to 7 to 9%. 7 to 9%, which, as you said, would it completely eviscerate people who are dependent upon that mark-to-market value of that asset collateral back in the potential liabilities. It's murder if that takes place. Now, it could happen from the front end too. We could see the 2 to 4% spread on the front end, but that means they're not just going to do one cut like they said that they're doing. Right? We're going to slow down. We have one cut in December, and we're not really worried about finding the neutral rate. Yeah, bullshit. That's not what this is saying, and this has been right every single time going back to its existence, because
Right.
the free market, the big money capital, just is smarter on the market trend than the small group of men that we have at the Fed, men and women at the Fed. But yeah, we could see the front end have to come back down to the 0.25% range. And then if the 10-year stay where it is now at 4, then we'd be right in that 2 to 4% spread. And it could come down to the 2% range and still be within it. But one way it's going to happen, they're either going to have to state the front end lower, or the market's going to call their bluff on their expectations and they're going to let the long end rip higher.
Rip
And
higher.
then that's the catalyst to what you were saying, where, you know, it's the most, it is a very I'm not even in the insurance business, but I understand enough to know this is a very legitimate concern. And the reality of this taking place is more plausible than not.
Oh yeah. Yeah, absolutely. And people are so blind to it. People, we talk about inflation, and the conversations are hilarious from executives where they're like, oh yeah, we feel comfortable with inflation going back to 3, and they're just so confident and calm in their just like uninformed, naive perspective of what's actually going on in the financial markets. So yeah, well, it'll be interesting to see where it how this plays out. But I've been,
what's your outlook? You think we get a second wave? You think we're gearing up?
yeah,
Yeah.
yeah,
Yeah.
dude,
And
yeah,
I agree with you. And I'll go one step further. I'll even say this. All those executives did exactly what you said. They didn't put the time and energy to study the markets and have an understanding. And they trusted the Fed, who said it's transitory. And they said, you know, it's transitory. This is temporary. It's going to come back down. And when it does, our margins will come back, right? Because
yeah,
the inflation passes through as a higher cost, which usually gets passed on to the consumer. But when you raise prices, you also lower demand. So they said, well, the Fed says it's transitory. We'll hold our prices. We'll just fight through this. We'll take smaller margins for a little bit, but when things get strong again, you know, it'll come back strong. We'll be right at that equilibrium that we want to be with supply and price. And
yeah,
it's not the case. And this time, if we get a resurgence, I don't think they're going to believe a transitory narrative.
yeah,
All of
right,
that,
right,
it's going to put, and it's going to exacerbate. It's going to be like throwing gasoline on the fire, because before they trusted them, now they're not going to trust them. And inflation and debasement can be significantly worse, because up into like it's going to be like Bitcoin, like,
yeah,
because now they're not going to wait. Now they're not going to trust transitory, and they're going to have to pass those costs, which is highly concerning in the insurance industry, because myself, you, and everybody knows your insurance prices have been going through the roof.
yep, yep. And I mean, you hit on the really main component there is trust, right? It's do you trust what the words that are coming out of the Fed's mouth? And it's I mean, that is like, that's why everybody's so highly anticipating the Jerome Powell conversations. Like, what's he going to say? Is he hawkish? Is he dovish? You're like, where are we going here? Because there's a lot that goes into his words, like his individual words and how they come out of his mouth. It's
Free market.
yeah. Yeah, that's crazy. It's crazy. But yeah, so I've been sounding the alarm bell a little bit within the industry, planting little seeds here and there. It's like, hey, FYI, look at this asset, Bitcoin. Look at the 4-year compound annual growth rate. Like, it's continuing to go up. You can think of this as like a 4-year plus bond, and like start to wrap your head around like different usages of this asset class. And I'll actually tie this back a little bit to MicroStrategy, because I think this is fascinating. So you can't put Bitcoin on your balance sheet. You get zero credit for it. But you know what you can put on your balance sheet? Equity. So if you put equity on your balance sheet, you get basically, let's just say 45% credit for every dollar that you hold. So now you can get 45 cents of leverage on that dollar that you hold in equity. Now, you know what you get more credit for? Bonds. Unrated bonds, which is what MicroStrategy's convertible debt is an unrated bond, and you get, let's just say, 55% credit. So now you start to get a little bit more credit for having this kind of, proxy Bitcoin exposure. And what do you get even more credit for? Rated bonds. So there's a future where MicroStrategy, when they're offering this convertible debt, if they get added to QQQ or the S&P 500, all of a sudden their credit rating goes to the roof. And we may be seeing A-rated MicroStrategy convertible debt being offered to large financial institutions at scale. And these these companies, like insurance companies, pension funds, et cetera, are going to be running to the table saying, yeah, I give me to 500 million, of these
Yeah.
convertible
Yeah.
debt, and I wanted to hold it on my balance sheet. And that is
I don't want my listeners to miss how important what Jeff just said was, because that is the direction that we are heading. This is the next evolution of financial instruments. Like we we talk about all the time
Yeah.
how Bitcoin is engineered money. You mentioned it before. It's special. It was better than gold because it has better characteristics. Yeah, because it was strategically designed to leverage the natural laws of economics to empower its holders. So when we see this and we say, okay, what happens next? Well, monetization happens next. We're getting that with the strategic Bitcoin reserve, which is looking fantastic. Um, but what comes after that, monetization, is integration into these old. I mean, think about it. These debt products have been around for thousands of
Forever.
years
Forever. Debt has been
with
around
no
forever.
innovation, with no
Forever.
innovation whatsoever. We
Yeah.
now have a way, because we now have money. We have the first form of perfect money. We now have a way to evolve debt products, and we can
Yep.
do it in a way to where the holder of that debt is actually protected from the debasement and from the inflation and from the mismanagement of monetary policy through centralized entities. So that future is a multi $100 trillion marketplace. And what Jeff just said about MSTR, and what makes it magic to me, is that we get to participate. Sailor is a public company. We all have our shares. And when Soros was going to bankrupt the Bank of England, nobody got to participate in that, right? These are the highest levels of financial engineering and warfare. But we, the people, actually, that's why I love Sailor. I think he's just a giga Chad, right? Giga Chad, giga brain. Fill in whatever adjective you want. That's him. But he's a fantastic person for the industry. So let me ask you this: with his strategy, which is just, I can't believe he's sharing it out in the open. That's like the cherry on top, right? It's
It's
like,
even better. It's less
I
selfless. Like,
told you what
come
to
on.
do. I told you
Yeah.
everything. Like that one shirt, that one Bitcoin shirt that says "I told you so." Like if anybody ever gets to wear that shirt, it's Michael Saylor. He's the one who gets to wear it. But what effect do you think that the strategic Bitcoin reserve, and what chances do you think that that is going to be official? And then what effect do you see that having on MicroStrategy, and then the
Yeah.
pace and acceleration of financial innovation?
Man, there's a lot there. First of all, I'm
Yeah,
gonna
I'm
what you
sorry.
said. No, no, what you said about the evolution of debt products and how you explained it gave me chills down my spine. You're so true. I mean, these are on the geological time scale of like Bitcoin and these financial products. Like Bitcoin's an infant, and people need to remember that we are in like way early days. It may seem like a long time, like 2009 to now may seem like a long time in your lifespan, but like 100 years from now, Bitcoin's still going to be around, and all of this data that we have over the last 10 years is going to be a blip. Right? Of like, it's going to be a blip on the scale of Bitcoin as an asset class in the future. So, I mean, just wanted to hit on that. Is so true. But I mean, thinking about the evolution of the asset and a strategic Bitcoin reserve, I think it's incredibly likely. I think it's incredibly likely based on the conversations that I've had with some folks, um, with where the political pressure that is there, the monetary pressure, the power pressure from the power that is Bitcoin will lead to a strategic Bitcoin reserve, because the game theory around this whole concept is like, if you don't do it, your competitor's doing it. China's doing it. Russia's doing it. UAE's doing it. All of a sudden, like that just exacerbates this accelerated game theory concept of losing power. And think about U.S. being the monetary powerhouse of um, of the world right now, right? That they are the monetary powerhouse because they did this with gold. Back in the
Mhm.
day, they did this with gold. The U.S. has 8 times more gold than the next closest country, and that just makes them incredibly powerful, right? Like you have power over every other country, let alone the fact that the dollar is the global reserve currency for now, which is a whole nother story. But just, actually,
But
I really like.
let me ask you real quick. Sorry to interrupt you, but do you think the strategic Bitcoin reserve is actually going to strengthen the dollar? And do you see a world where both the dollar and Bitcoin can get stronger together, or is it has to be an enemy?
Yeah, I think I think you're definitely right. There's this potential for a hybrid economy where the dollar does get stronger with a Bitcoin component. it, it's an interesting thought experiment thinking about like, well, what does the government look like in the future, right? Like if, are we going to be able to pay taxes in Bitcoin? Is there a point where the Fed is evaporated? If the Fed is evaporated, how does the dollar work? Is the dollar going to be backed by, I mean, the next 20 years of this is going to be incredible. Like there's definitely going to be some sort of hybrid economy. That's definitely where we're going. Where if you think about the current structure and the strength of the dollar, the reason the dollar is strong, and I highly recommend anybody listening to this podcast to listen to or to read the chapter of the petrodollar from Lynn Alden's Broken Money. And it explains why the dollar is strong. And it's been strong since I think the Nixon era. And Nixon told his economic advisor, okay, you're going to go to the UAE, and you're going to go to these oil countries. You're going to go to Saudi Arabia, and you're not going to come back unless you have a deal done. And basically, he went there in the 70s and said, okay, hey, we're going to buy a ton of oil from you guys, right? We're going to buy so much oil from you guys. In exchange, you need to price oil for everybody else in the world in dollars. And that required every other country in the world to hold dollars. That created instant demand for dollars because the whole world was run by oil. And they also said, in exchange for you pricing all of this oil in dollars, we will protect the transportation of your dollars with our naval fleet, which is better than any other naval fleet in the entire planet. So it's a great deal, right? You've got instant demand. Like these countries are going to get incredibly wealthy because they're going to buy a ton of oil. And then the dollar gets incredibly wealthy because there's so much demand for the dollar globally. So great concept. Now, this breaks down if there's another global currency that is widely accepted and those other countries say they don't want dollars anymore, they want Bitcoin. And I think there's a high likelihood that these oil selling countries will convert and shift to a separate currency that is globally accepted, globally liquid, and finite, that cannot be manipulated. Because the only problem there is, great, you got all these dollars and you're this rich oil company or this rich oil country, but your dollars are getting debased. They're worth less because the Fed is debasing them. So there's going to be alternatives there, and I think these countries will explore those alternatives, and it could happen much faster than we think. And if that starts to happen,
is, right? With BRICS.
Yeah, with BRICS.
For those of I know a lot of my listeners are also listeners of Luke Groman, who has done a really good job of laying out how trade surpluses are now finding their way back into gold. And that could be one of because why hold debasing dollars? There's one guarantee that we have, because even if Elon gets in there with Doge and cuts and eliminates fraud and makes things more efficient, the problem with the budget is that you could eliminate the entire government. But just the just the entitlements, right? Like just the entitlement programs like Social Security, Medicare, Medicaid, net interest, and military. That's more than $5 trillion. And we only collect $5 trillion in taxes. So even if you eliminate every single government job and every single government agency, we still have a budget deficit based on the promises that we have. That's where that 219 trillion unfunded liabilities comes into play. We're in that dire situation. So I'm hoping that doesn't accelerate, and getting Bitcoin on the asset side of the balance sheet, like you were saying, what can we put it into? Can we put it into stocks? Can we put it into real estate? What can we drive value into? We borrow $1 and spend it into the economy. We get less than $1 worth of return. If we try to pump housing, we get less than $1 worth of return. If we try to pump stocks, we get less than $1 worth of return. Enter magic internet money, $2 trillion asset. You put $1 in, you get upwards of $10 to $100 back, depending which part of the marketplace you put it in. This is right. We could recapitalize the republic with Bitcoin strategy being integrated into our policies, into our business models. And this is like the very beginning of that transfer, of that transition. I can't believe we're here and alive for it. I mean,
isn't it crazy? It's crazy, isn't it?
Is this really happening? You know, like, is this, and then to see Saylor lay out the game plan.
Yeah. And he's like, I'm going to take us to the promised land.
I will show you how this works. Now, I put into the community about some questions they had. So I want to throw some questions your way from them,
Yeah.
give them a shout out to the MSTR community. Great community.
Yeah.
If you guys haven't checked them out, then you should definitely go back to the beginning of the episode, listen to Jeff, look at his community. It's open and it is alpha, straight alpha. So you'd be crazy not to check it out. But here's some of these questions from people in the community. So here's a good one. Please discuss counterparty risk of MSTR's custodians. So how do you feel about where MSTR is having their Bitcoin held? And do you have any concerns about the custody and counterparty risk with that setup?
Yeah, it's a great question. I think there's some Bitcoin maxis that think that, Sailor or MicroStrategy should self custody all of their coins. And I think that is one of the most insane concepts I think I could ever imagine. There's no way any board or any publicly traded company, like any shareholder, would want like three dudes holding the keys to $30 billion, right? Like that's just insane. Yes, there's going to be counterparty risk um, everywhere. Like all of these corporations are eventually going to be holding their Bitcoin in alternative places. So MicroStrategy, they hold their Bitcoin with Coinbase Prime and Fidelity. They've also Sailor's talked about it, and I think this is an incredibly important component. But SAB 121, which is supposed to allow banks to custody Bitcoin. This was a bill that was passed by the House, passed by the Senate, bipartisan support, overwhelming bipartisan support, and then was vetoed by Biden last year. I think there's a chance we see that overruled in the new red wave administration, and banks will be allowed to custody Bitcoin at some point in the future. This is incredibly important because your counterparty risk then goes from Coinbase to JP Morgan. It goes from an $80 billion company to a $700 billion global systemic too big to fail banking institution.
Yeah.
That's a completely fundamentally different risk profile, right?
Yes.
And all of a sudden, boom, now there's 10 banks or three, four, five banks that are systemically large, important institutions that you can custody your Bitcoin with. And I think that's the way this is going. We're going to see this happen at some point in the future. Now, there's going to be a lot of technology that's developed and infrastructure that's developed around this as well, like with the development of Miniscript and multisig, where there's going to be rules and technology built in via code on the Bitcoin ecosystem where you can either tie this up with time locks over time, or you have rules in place like you need to have certain people have access to the keys in order to be able to move it, and if those people don't have access to the keys, you move to this kind of like layer 2 protection of like, okay, if none of those people have access to the keys, then you need XYZ to happen. And then there could be even like layer 3 protection where you move into these other rules. And people don't, most people that are invested
power
in
of programmable money, right? People realize
programmable money.
It's limitless. You can do
Yeah.
whatever you need to do when these tools start hitting. And time locks are actually really interesting because we're looking into that for Bitcoin bonds. Here's another question. Let's see. Can you guys discuss the fact that there is zero difference in operating earnings versus treasury earnings? Should we not assign an absurd PE to MSTR and not fret over MNAV, like a PE double that of Mag 7, who are now pikers?
Yeah. Yeah. This is an interesting concept. So basically what's happening, and nobody knows this. Nobody on the street knows this. I mean, there are definitely smart people that know this, but basically you go look at MicroStrategy's earnings over the last 4 years since they started their Bitcoin strategy, their earnings have largely been negative. And so anybody on the surface level going to look at this company, they go look at the financials, they look at the negative earnings, and they say, oh, this is a fraud. I'm out of here. I'm not investing in the company. They don't understand that the accounting is using dated accounting principles. And the dated accounting principles effectively mean that anytime there's a drop in value of Bitcoin during the quarter, MicroStrategy has to mark down their entire Bitcoin holdings to the value at the lowest point during the quarter. So MicroStrategy's Bitcoin held on their balance sheet, I don't know what it is as of today. It's pretty high, but they're at least holding a $15 to $20 billion gain that is not reflected in their earnings per share on their balance sheet. So in fact, it's quite the opposite. It's reflected a loss
Yeah.
because of the way that it's just technically accounted. This is called intangible long-lived asset value accounting. Basically, Bitcoin is treated as a patent that's illiquid. And starting in 2025, there's a new accounting system called FASB, fair value accounting, where the value of the Bitcoin at the end of the quarter is reflected at fair value, and that's reflected on a balance sheet. Any gain on the Bitcoin holdings during that period, during that quarterly period, flows through to retained earnings and net income bottom line, which will flow through to earnings per share for MicroStrategy. So this
It's
question,
efficiency, right?
yeah,
It's just crazy that's how like traditional this is. Like when we say tradfi and we say traditional finance, traditional, like when we say traditional, we mean like old practices, right? Because anybody listening to this is like common sense. Wait a second, what? Bitcoin is
yeah,
being treated like a patent product. I can't. What is this? Is this some banker game like mark to market? Do I get to pretend
yeah,
my securities are still worth more than they are? Like, no, we have to pretend it's worth less than it is. It's just that type of inefficiency really just highlights the need for the updates of
yeah.
of what's coming, and when it comes, everything will accelerate. And by the way, if you haven't watched Jeff's pinned video on his profile, go ahead and do that because that was a while ago, and he gave price projections based on his analysis and his models, and he hit it now on the freaking head. Now on the freaking head. He said Bitcoin 250 would be around $800 MicroStrategy. Well, we're about 100. We're like a little less than half, and we're at $400. So for his models are working beautifully. Pay close attention to them and take what he says seriously. Here's another question: could the ATM alone increase Bitcoin yield without someone being an expert at selling MSTR and buying BTC? Or is it a combination of the ATM and the converts that give us the BTC yield?
Yeah, good. That's another good question. And really, it's both. Both are yielding. Both are ATM, for those that are unaware. An ATM is an at the market issuance. So MicroStrategy has been approved to sell $21 billion of ATM issuance into the market. Most equities, when you hear an ATM issuance, this is like sound the alarm bells. I'm getting diluted, right? Like it's usually like warning, like you're getting diluted, like the value of your equity is going down. Now, in this circumstance, you're getting accreted. And what I mean by that is when Saylor is selling shares. So right now, the company holds $30 billion of Bitcoin. The company is trading at $90 billion. So if you sell one share, the company is valued at more than the underlying Bitcoin holding. So if you sell a share, you actually are able to capture that monetary premium and buy more Bitcoin.
Yeah.
So this is resulting in increasing Bitcoin per share for everybody that's holding the stock. So if you hold the underlying equity, you're big, like with Saylor offering these shares at the market, they're generating income to buy more Bitcoin. And that's increasing the Bitcoin per share for every holder. So that's where you get this kind of yield from. So there's two components. They've got the ATM and then this convertible debt, and they're effectively both providing a yield, a Bitcoin yield, by increasing shares at a lower rate than they're increasing their Bitcoin holdings.
Yeah, well, I mean, it's an amazing concept, and I love that they're being aggressive with it and introducing it. And I think Dylan LeClaire's company adopted the Bitcoin yield because that's what the goal is here, guys. The goal is to accumulate as much Bitcoin as you possibly can, because
Yeah,
the United States is going to create a national strategic Bitcoin reserve. The federal government is going to hold Bitcoin and eventually accumulate it. Well, the federal government is not the state government. So the state government is going to create Bitcoin reserves and accumulate it. Well, the state's balance sheet is not the city's balance sheet. So now cities and municipalities are going to create strategic Bitcoin reserves and start accumulating it. Small and medium-sized businesses, corporations. This is going the positive feedback loop and flywheel of the National Strategic Bitcoin Reserve in the United States of America becoming, whether it's implemented through executive order and later law in Congress, that's going to accelerate this to the point where when you hear Jeff talk about MicroStrategy getting to $10,000, even $15,000 a share, this is not a Banana Republic crazy. This is not far-fetched concept. This is
Yeah.
absolute digital scarcity playing its role in price discovery and then pushing through to the balance sheet of the company who saw it coming.
Yeah.
Last question from the community here from Ron. He's a cool guy. Is MSTR insulated against BTC downside risk? I.e., what if a 50% price reduction for BTC? Do you think MSTR will be correlated 1-to-1 and also go down 50%?
Yeah, this is another good question, and it's an interesting and fun thought experiment, right? So, as we clearly laid out just previously, the MicroStrategy has two instruments to increase BTC yield because the value of the company trading is significantly larger than the value of the underlying Bitcoin holdings. They also have the ability to raise this convertible debt that's got a long horizon, like 4, 6, 8 years, whatever that may be. So you've got two components to continue to add Bitcoin to the balance sheet. Now, there's also this concept and aspect of passive index ETF flows. So the design of the equity market, MicroStrategy is already included in 150 plus passive market cap weighted index ETFs. So as the value of the company increases over time, their proportion and relative strength within that passive market cap weighted index is increasing. So any new dollars that come into the system, any new dollars that come into the S&P or to Russell 1000 or QQQ or S&P 500 will eventually find their way into buying MicroStrategy shares at any price. So you've got potential future buyers kind of no matter what, just based on the design of the existing equity market. So that could potentially work in both ways, reflexive down as well as reflexive up. So in thinking about how MicroStrategy may kind of how this may play out at some point in the future, if you look at the last cycle and the last drawdown, when FTX blew up, Celsius, BlockFi, all that, MicroStrategy was, I don't want to say in a pickle, but people were a little worried about their financial strength, being that the value of their Bitcoin was worth less than the liabilities that they had on their balance sheet. Fast forward to let's think about a future potential bear market. MicroStrategy is going to be in a significantly different position, right? They're going to be in a position of power and strength as opposed to a position of concern. And I think that's a very interesting thought experiment to think about. Okay, are these products and are these instruments that Michael Saylor is available to leverage, are those viable in a bear market? Like, are they still trading at a premium or a multiple to their asset value? If so, you can still leverage the ATM offering and buy more Bitcoin. Is the convertible debt market still available? Are these products? Is there still demand for these products in the insurance pension fund in these other markets? And I think the answer is likely yes. So there are other instruments that Saylor is going to be able to utilize as in a position of power and strength to help potentially alter what a future bear market may look like. We're going to get pullbacks, right? Like there's going to be situations where like we could see a blow off the top. This thing could run to 1 million and then drop back down to 400,000 or something like that. That could certainly happen. However,
Yeah, that's.
like
I was just going to say, you saw British Hodl's tweet where it's almost like he wants to let it to happen and then set a floor with those ATMs and convertibility notes because the demand, like you said, is going to be there. And you could literally set a floor. And if you set a floor and Wall Street knows that, then the market dynamics, these 4-year cycles, I think are going to start to mature. Would you agree?
Yeah, 100%. I kind of see it when I close my eyes. I could kind of like see the cycle, like the supply curve, right? If you graph out the supply curve, the next 10 years is the gold rush. And Saylor's even said this. I love that he's dubbed it the gold rush. It's so perfect. It's so perfect. The next 10 years, in 2032, 99% of the Bitcoin that will ever be in circulation will have been mined. The last 1% is mined over the next 100 years. So effectively, we're in the gold rush for the last remaining 4-6% or whatever the number is that's going to be mined and put out into circulation over the next 10 years. So we're going to see some volatility, but I suspect if the US government's on the bid, if these nation states are on the bid, if these corporations and everybody's on the bid, like this could get nutty, and all of a sudden you just don't know where the bottom or the floor is. It's just like you're better off just holding in DCA buy in perpetuity, because that's what these other companies are going to be doing.
That's
Um,
right.
so yeah,
Perpetual
it's
base
wild.
layer demand growing faster than the internet economy. Perpetual base layer demand growing faster than the internet economy. We are moving into that time where the internet got web stores. Nobody cared about it until you could buy stuff there. That's Bitcoin. We are now
Yeah.
going to see a base layer of demand explode. There's going to be a perpetual bid. Unbelievable times. Ladies and gentlemen, Punter Jeff, thank you so much for joining me here today. I hope we get to do it again. We should come back next year after it starts to get wild and give everybody an update, show them how accurate you were. You guys, you have to follow Punter Jeff if you're not already. You're crazy. Look at his research, literally study his research. Don't look at his research, study his research. This can change your life. This can change you and your family's life. This is the type of once in a civilization opportunity where we're seeing an emergence of a new asset class that is now being monetized by the entire world. Jeff, I want to leave you with the last word with the audience.
Yeah. You said it great there. I mean, this is a new frontier of digital capital. We're experiencing something. We're incredibly lucky to be experiencing this time in history, and it would be silly to not spend time to learn about what's going on. So thank you to everybody that's joined and listened, and follow me on Twitter X. And we've got a couple pretty big communities out there. Irresponsibly Long MSTR is a community out there. There's some fun chatter going on in that, and there's a Discord available as well. So feel free to reach out, ask questions, jump into the community. There's a lot of people having really bright conversations on X, and really good research by many people out there. So that's a lot of fun.
Awesome. Thank you so much, Jeff. And I look forward to doing it again.
Absolutely. Thank you.
Take care.